Something shifted overnight in the silver market. Not a rumor, not a forecast. An actual break in price structure that caught the attention of institutional desks, commodity analysts, and long-term holders alike. If you own silver, or if you've been watching it, this moment demands your attention. Not because you need to panic, but because you need to understand what just happened, why it happened, and what it might mean for the months ahead. I'm not here to tell you silver is going to the moon or crashing to zero. I'm here to walk you through what changed, what didn't, and how experienced investors are thinking about this right now. Because here's the reality. Most people will react to this move emotionally. They'll either sell in fear or buy in greed, guided by headlines rather than understanding. And that emotional reflex, repeated across thousands of investors, is often what creates the opportunities for those who remain calm. So let's slow down. Let's examine what actually occurred. And let's talk about what it means for you, whether you're holding the asset or considering it. Silver experienced a sharp, sudden decline that accelerated during overnight trading sessions. The kind of move that doesn't unfold gradually, but snaps lower in a condensed window of time. This wasn't a slow grind, it was a break. The price fell through technical support levels that had held for weeks, triggering algorithmic selling, stop-loss orders, and a cascade of forced liquidations. Within hours, silver had surrendered gains that took months to build. For those watching closely, the move had all the hallmarks of a leveraged unwind. Futures positions being closed, margin calls being met, speculative froth being wrung out of the market. And here's what matters. This kind of move doesn't happen in a vacuum. It happens when leverage has built up quietly beneath the surface, when positioning becomes lopsided, when too many traders are leaning the same direction, confident that momentum will carry them forward. Then something shifts, a data point, a policy signal, a change in sentiment, and the rush for the exit begins. This is not unusual in commodity markets. In fact, it's one of the most predictable patterns in finance. Not predictable in timing, but predictable in structure. Silver is not just another commodity. It sits at the intersection of industrial demand and monetary speculation. It's used in solar panels, electronics, and medical equipment, but it's also held as a store of value, a hedge against currency debasement, and a speculative asset during inflationary cycles. That dual nature makes silver uniquely volatile. When industrial demand weakens, or when risk sentiment shifts, silver can fall hard and fast. When inflation fears rise, or when investors lose confidence in fiat currencies, silver can rally with extraordinary speed. Right now we're in a transitional moment. The macroeconomic environment is sending mixed signals, and silver is reflecting that confusion. On one hand, global debt levels remain historically elevated. Central banks continue to expand their balance sheets, even if the pace has moderated. Currency debasement, by any reasonable measure, is ongoing. On the other hand, interest rates have risen meaningfully from their lows. Real yields have turned positive in some markets, and inflation, while still above target in many regions, has cooled from its recent peaks. Silver doesn't know which narrative to follow, so it whipsaws. And that whipsaw just produced a violent move lower. Let me explain something that most retail investors don't fully appreciate. The silver market is heavily influenced by leveraged positions in the futures market. These are contracts that allow traders to control large amounts of silver with relatively small amounts of capital. When prices are rising, leverage amplifies gains. Traders pile in, optimism builds, positions grow. But leverage is a double-edged sword. When prices reverse, those same positions must be closed or collateralized. If a trader can't meet a margin call, the position is liquidated automatically. And when many positions are liquidated at once, the selling pressure overwhelms the market. This is what appears to have happened. The decline accelerated not because the fundamental case for silver collapsed overnight, but because the structure of the market itself created a self-reinforcing downward spiral. This is critical to understand. The move was technical in nature, not necessarily fundamental. That doesn't mean fundamentals don't matter. They absolutely do. But it does mean that the overnight crash was as much about market mechanics as it was about economic reality. Here's where most investors go wrong. They see a sharp decline and assume something is broken. They interpret volatility as a signal to exit, to cut losses, to protect themselves from further pain. But volatility is not the same as risk. In fact, for long-term holders with conviction, volatility is often the price you pay for asymmetric opportunity. The assets that never decline are usually the assets that never generate meaningful returns. Silver has always been volatile. It's part of its character. Go back and study the price history. You'll see massive rallies followed by brutal corrections. You'll see periods of consolidation that last years, followed by explosive moves that unfold in months. This is not new. This is how silver behaves. The question is not whether silver is volatile. The question is whether the long-term case remains intact despite the volatility. And that's a question each investor must answer for themselves, based on their own time horizon, their risk tolerance, and their understanding of the macro environment. Let's zoom out. We are living through a period of extraordinary monetary expansion. Over the past 15 years, central banks have injected trillions of dollars, euros, yen, and yuan, into the global financial system. The stated purpose was to prevent deflation, support economic growth, and stabilize markets during crises. The unstated consequence has been asset price inflation, widening wealth inequality, and a buildup of debt that now exceeds global GDP. This is not conspiracy. This is documented policy. And it has profound implications for hard assets like silver. When currency is abundant, when debt grows faster than productive output, when trust and institutional stability begins to erode, investors historically turn to tangible stores of value. Gold, silver, commodities, real estate, things that cannot be printed or diluted at will. This dynamic hasn't changed. What has changed is the short-term narrative. For the past year, the narrative has been that central banks are tightening, that inflation is under control, that the crisis has passed. But look beneath the surface. Government debt continues to climb. Deficits remain structural, not cyclical. The cost of servicing that debt is rising as interest rates normalize, and political pressure to ease monetary conditions is building. This is the environment we're in. And in this environment, corrections in assets like silver are not the end of the story. They're often the chapters that create opportunity. Let me take you back to previous cycles. In 2008, during the global financial crisis, silver collapsed alongside almost every other asset. It fell from over $17 an ounce to below $9 in a matter of months. People panicked. They sold. They declared silver dead. Then, over the next 3 years, silver rallied to nearly $50. In 2013, after that rally exhausted itself, silver entered a brutal bear market. It ground lower for years, testing the patience of every holder. By 2015, it had fallen below $14. Again, people gave up. They moved on. Then, in 2020, as pandemic-era monetary expansion reached unprecedented levels, silver surged from $12 to nearly $30 in a matter of months. Do you see the pattern? Silver doesn't move in straight lines. It moves in cycles. Boom, bust, consolidation, breakout. And the investors who profit are not the ones who try to time every move. They're the ones who understand the cycle, who buy during despair, who hold through volatility, and who take profits during euphoria. This overnight crash, it's painful if you bought recently, but in the context of history, it's not unusual. It's not even surprising. Here's what happens when an asset crashes overnight. Fear takes over. The headlines scream, social media floods with panic, and the instinct to protect yourself, to stop the bleeding, becomes overwhelming. So you sell, and by selling, you lock in the loss. You crystallize the damage. You exit at precisely the moment when the price is most depressed and the opportunity is most compelling. This is the trap that catches most retail investors. They buy high, driven by optimism and momentum. They sell low, driven by fear and capitulation. And they repeat this pattern across cycles, wondering why they never get ahead. Professional investors think differently. They view sharp declines as potential entry points, not exit signals. They assess whether the underlying thesis has changed, not just whether the price has fallen. If the thesis remains intact, they often add to positions during weakness, not because they know the bottom is in, but because they understand that buying during fear has historically produced better outcomes than buying during greed. This doesn't mean you should blindly buy every dip. It means you should have a framework, a thesis, a plan, and you should execute that plan with discipline, not emotion. Let's address the elephant in the room. If you own silver, you're probably looking at your portfolio right now and feeling some combination of frustration, confusion, or concern. That's normal. That's human. But let me ask you a question. Why did you buy silver in the first place? If you bought it because you believe in the long-term case for hard assets in a world of currency debasement, has that case changed? If you bought it as a hedge against systemic risk, has that risk disappeared? If you bought it because you believe industrial demand for silver will grow as the world transitions to renewable energy, has that demand evaporated? Probably not. What has changed is the price. And price, in the short term, is driven by sentiment, positioning, and market mechanics as much as it is by fundamentals. So the question is not whether you should sell because the price fell. The question is whether your original thesis still holds. If it does, this decline is noise. Painful noise, but noise nonetheless. If it doesn't, if something fundamental has shifted that invalidates your reason for holding, then you should reassess. But that reassessment should be based on logic, not emotion. Now let's talk to those who have been watching silver but haven't committed. This crash might look like vindication, proof that you were smart to stay away, proof that silver is too risky, too volatile, too unpredictable. And maybe that's true for you. Maybe silver doesn't fit your risk profile or your time horizon. But consider another perspective. Every major opportunity in financial markets has been born from moments of panic. The best entry points are almost always when sentiment is negative, when headlines are dark, when the crowd is running for the door. This doesn't mean you should rush in today. It doesn't mean the bottom is in. It doesn't mean silver can't fall further. But it does mean that if you've been interested in silver as a long-term holding, this type of move creates the conditions where thoughtful accumulation becomes possible. The key word is thoughtful, not impulsive, not emotional, not based on someone else's timeline or conviction. If you're going to enter, do it with a plan. Dollar cost average over time. Set a budget you're comfortable with. Understand that volatility will continue. And be prepared to hold through cycles, not trade around them. Let me be direct about something. If you are trading silver with borrowed money, with margin, with leverage of any kind, you are playing a dangerous game. This overnight crash is a reminder of what can happen when leverage meets volatility. Positions get liquidated, capital gets wiped out, and traders who were right about the long-term direction still lose because they couldn't survive the short-term move. Leverage turns investing into gambling. It compresses your time horizon. It forces you to be right about timing, not just direction. It subjects you to margin calls, forced selling, and emotional decision-making under pressure. If you're holding physical silver, this crash is painful but manageable. You still own the asset. You can choose to hold or sell based on your own assessment, not based on a broker's demand. But if you're levered, you don't have that luxury. So if you take one thing from this video, let it be this. Never use leverage on volatile assets unless you are a professional trader with the capital, the systems, and the emotional discipline to manage the risk. For everyone else, stick to cash positions. Accept that your gains will be slower, but recognize that your downside is limited, your decisions remain yours, and you can sleep at night. Let me be explicit about the mistakes you should avoid. First, don't make decisions based on today's price alone. A single data point tells you nothing about the trend, the cycle, or the opportunity. Second, don't chase the narrative. Whatever story is being sold to explain this crash, remember that narratives are often constructed to fit the price action, not the other way around. Third, don't assume this is the bottom. Sharp declines often find temporary support, rally briefly, then continue lower. The bottom is only obvious in hindsight. Fourth, don't ignore your own risk tolerance. If this move has you losing sleep, if it's affecting your mental health or your relationships, you may be overexposed. And that's not a market problem. That's a position sizing problem. Fifth, don't blindly follow influencers, newsletters, or forums. Everyone has an agenda. Everyone is managing their own position. Your situation is unique, and your decisions should be yours. And finally, don't forget that markets cycle. This decline will not last forever. Neither did the rally that preceded it. And neither will the rally that may follow. Stay grounded, stay informed, stay disciplined. Let's step back and consider where we are in the broader cycle. We are in a period of transition. The easy money era is fading. Interest rates have normalized from historic lows. Inflation has moderated, but remains structurally embedded. And governments are trapped between the need to control deficits and the political impossibility of cutting spending. This is not an environment where assets move in one direction for long. Instead, we're likely to see volatility across the board. Stocks, bonds, commodities, currencies, all of them will experience whipsaws as the market tries to price in an uncertain future. Silver is simply reflecting that uncertainty. But here's what hasn't changed. The supply and demand fundamentals for silver remain compelling. Industrial demand is growing, particularly in green technologies. Mine supply is constrained, and above-ground inventories are tighter than they've been in years. At the same time, the monetary case for hard assets has not disappeared. Debt levels are unsustainable. Currency competition is intensifying, and trust in traditional financial institutions is eroding. These are long-term forces. They don't resolve in a week or a month. They unfold over years, and that's the time frame that matters for disciplined investors. Let me share how experienced allocators are likely viewing this moment. They're not panicking. They're not celebrating. They're assessing. They're asking whether this decline has created value or exposed weakness. They're reviewing their thesis, checking their position sizes, and considering whether to adjust. Some are using this as an opportunity to scale into positions they've wanted to build. Others are taking partial profits if they bought significantly lower, using volatility to rebalance portfolios. But almost none of them are making binary, all-or-nothing decisions based on a single overnight move. They understand that markets overshoot in both directions. They understand that the best opportunities often come disguised as disasters. And they understand that the ability to remain calm when others are panicking is worth more than any analytical edge. This is the mindset that separates long-term wealth builders from short-term speculators. It's not about being smarter. It's about being more patient, more disciplined, and more willing to think independently. Let me tell you something that no one wants to hear. Building wealth through investing is slow. It's boring. It requires patience that most people simply don't have. You're not going to get rich from a single trade. You're not going to time the exact bottom or the exact top. You're not going to outsmart the market consistently. What you can do is develop a sound thesis, allocate capital responsibly, and give that thesis time to play out. In the case of silver, That might mean holding through this decline, through the next one, and through the inevitable rally that follows. It might mean buying small amounts over many months, regardless of price, trusting that your average cost will be reasonable over time. It might mean doing nothing at all, simply watching and learning, waiting until your conviction is strong enough to act. All of these are valid approaches. None of them involve reacting emotionally to overnight moves, because here's the truth. The investors who succeed long-term are not the ones who react fastest. They're the ones who think clearest, who act with discipline, and who understand that wealth is built in years, not days. So where do we go from here? I don't know. Nobody does. Silver could continue lower. It could consolidate at these levels. It could snap back violently. All of these outcomes are possible, and none of them would be surprising. What matters is not predicting the next move, but being prepared for multiple scenarios. If you hold silver, prepare for further volatility. Prepare for the possibility that this decline continues, but also prepare for the possibility that you'll look back on this moment as an opportunity you were glad you didn't abandon. If you're considering silver, prepare to act methodically. Don't try to catch the falling knife, but don't wait for certainty either, because certainty only arrives after the opportunity has passed. And regardless of where you stand, prepare to ignore the noise. The headlines will continue. The experts will debate. The social media feeds will flood with opinions. Your job is to filter that noise, to focus on what actually matters, and to make decisions that align with your goals, your risk tolerance, and your time horizon. Let me level with you about something. Investing is fundamentally an exercise in uncertainty. You're making decisions today based on incomplete information about an unknowable future. Anyone who tells you they know exactly what silver will do next is lying, to you or to themselves. What we can know is history. We can study cycles. We can understand the forces that drive markets. We can assess probabilities, but we cannot eliminate uncertainty. And that's okay, because investing is not about certainty. It's about making probabilistic bets with favorable risk-reward profiles, and then managing those bets with discipline. This crash doesn't change that. It simply reminds us that volatility is real, that markets are unpredictable in the short term, and that emotional control is the most valuable skill an investor can develop. Silver just experienced a violent overnight decline. For some, this is a disaster. For others, it's an opportunity. For most, it's simply confusing. But here's what I want you to remember. Markets cycle. Assets rise and fall. Sentiment swings from greed to fear and back again. This is not new. This is how markets have always worked. Your job is not to predict these swings. Your job is to understand them, to prepare for them, and to act with discipline when they occur. If you hold silver, remember why you bought it. Assess whether that reason still holds. And if it does, this decline is not the end of your thesis. It's a test of your conviction. If you're considering silver, remember that the best opportunities often emerge from chaos. Not today, necessarily. But over time, as the panic subsides and the fundamentals reassert themselves. And if you're simply watching, learning, trying to make sense of all this, know that you're doing exactly what you should be doing. Building knowledge, developing judgment, preparing yourself for the moments when conviction and opportunity align. This crash matters. But it's not the whole story. The whole story is unfolding over years, across cycles, through periods of fear and greed, through crashes and rallies and everything in between. Your success will not be determined by what you do today. It will be determined by what you do consistently over time with discipline and patience. Stay informed, stay thoughtful, stay grounded. And remember, understanding cycles and preparing for volatility will always matter more than reacting to noise. Thank you for watching.